So we have looked at cost of investment, the different ways of finding the cost of investment. And we have said we can use cash, we can use share exchange, or we can use loans. So let's go to an example. The example we have here reads, H acquired 24 million one share, 80% of the ordinary shares of S, by offering a share for share exchange of 2 shares for every 3 shares acquired in S Limited, and a cash payment of $1 per share payable 3 years later. H Limited shares have a nominal value of $1 and a current market value of $2. The cost of capital is 10%, and $1 receivable in 3 years' time can be 0.75. So the discounting has already been done to you, and it has given you a rate of 0.75. So required, calculate the cost of investment and show the journals to be recorded in H accounts. And number 2, show how the discounts would be unwound. So H acquires 24 million, 80% of the ordinary shares of S by offering a share for share exchange. So the first way which was used in this case was share for share exchange, and a cash payment of $1 per share payable 3 years later. So there was also a cash payment payable 3 years later. So because it's 3 years later, it is deferred cash. H Limited shares have a nominal value of 1 and the current value of that. The cost of capital is also given. So in this question, there were 2 ways that the company acquired the subsidiary. Subsidiary because it is 80%. Number 1, there was share for share exchange. And number 2, there was deferred cash payment. So deferred cash payment and share for share exchange. So there was deferred cash and there was share for share exchange. Share for share exchange, and there was also deferred cash. So let's go to Excel. Can you just confirm through chat, anybody randomly? Can you see the Excel sheet through the chat so that we move on? Chat, please. Can you see the Excel sheet? Okay, let's move on. So it's the same question that we have posted in Excel sheet. So in the question reads, required, calculate the cost of investment and show the journals to be recorded. So in our solution to this question, and it is example 5. Example 5, the objective is to know how to calculate cost of investment. Cost of investment is also known as purchase consideration. So when we talk of cost of investment, it is also known as purchase consideration. So in this question, there were 2 acquisition methods. Two acquisition methods. There were 2 acquisition methods. Number 1, share exchange. And number 2, there was deferred cash. So we'll be covering them one by one. So let's start with number 1, share exchange. Share exchange. And let us read once more. H acquired 24 million shares. I believe that is clear there. H acquired 24 million shares. And the value is 80%. So which means these 24 million shares of the value of $1 each, this is equivalent to 80% of the ordinary shares of S by offering a share for share exchange of 2 shares for every 3 shares acquired in S. So in share exchange, the cost of investment we have said is equals to cost of investment is equals to shares acquired times ratio of parent divided by ratio of subsidiary times MPS of parent. So that is how we get the cost of investment. Cost of investment. So we are trying to say, let me repeat that here. Cost of investment is equals to, cost of investment is equals to 24 million shares times the ratio was by offering a share for share exchange of 2 shares for every 3 shares acquired. So 2 for every 3. So ratio of parent is 2, ratio of the subsidiary is 2 for every 3 times the MPS of the parent. What is the MPS of the parent? H Limited shares have a nominal value of that. The cost of capital is 1 receivable and 3. I'm looking for the MPS of the parent. 2, here, it's here. The nominal value of $1 and a current market value of $2. So the market value of the shares is $2. So that is how cost of investment is computed. So if I put it here, it will be 24 million times 2 divided by 3 times 2. So it will give you 32 million. I'm repeating. 24 million is given in the question here. The ratio 2/3 is ratio of parent. They were giving out 2 shares for every 3. So of the parent becomes the numerator, of the subsidiary becomes the denominator. So cost of investment will be the number of shares times ratio of parent, which is 2, divided by ratio of subsidiary, which is 3, times MPS of the parent. So it gives us a total of 32 million. So that was number 1. It was through share exchange. Number 2, there was deferred, but I will still come back to that share exchange. I'm not done. Deferred cash. So the second way was through deferred cash. Now, in deferred cash, we were told, it's still in the first sentence, 2 shares for every 3 shares acquired in S and a cash payment of $1 per share, payable 3 years later. $1 per share, payable 3 years later. And a cash payment of $1 per share, payable 3 years later. So the cost of investment will be equals to, in this case, it will be equals to, you have been told $1 per share. So we have 24 million shares times 24 million shares times $1 per share times the discounting rate. Discounting rate is 1 divided by 1 plus R raised to power N times, but here we have been told to use 0.75. You have been told to use 0.75. So I'm using what you have been told. You have been told it is 0.75. But if you have not been given, you calculate it as this. 1 divided by 1 plus R raised to power N, where R is the discount rate divided by 100. R is the discount rate, which in this case is 10%, which is equals to 10%, which is the same as 0.1 when we divide by 100. N is the number of years. I'm doing this because in another question, you will not be given the 0.75 number of years. So if you have not been given the 0.75, you calculate it through using the formula 1 divided by 1 plus r raised to power n, where r is the discount rate, which is 10%, which is equivalent to 0.1, and n is the number of years. Let's try doing it. We are saying 1 divided by 1, let me use bracket, 1 plus 0.1, that is 10%, raised to power 3 years. So what do we get? The answer, the result that we get is the result we get is 0.75. You can see there. And that is the same as this 0.75. So if you have not been given the 0.75, you can calculate it using the formula 1 divided by 1 plus r. So instead of dividing here, I just applied the formula that we were given. So let's calculate the amount. The amount is 24 million times 1 times 0.75. So that gives you 18 million. So when we get that 18 million, what is the total cost of investment? The total cost of investment is equals to, you add those two, 32 million plus 18 million. So the total cost of investment that we will use to enable us calculate goodwill is 50 million, is 50 million. So we had number 1, share exchange, and number 2, deferred cash. We will still look at another example. But now let's go back to analysis of share exchange. This is just enabling us know the amount to used when calculating goodwill. So let me put here, used when calculating goodwill, so that you know where you will apply it when calculating goodwill. So let's go back to analysis of share exchange. We said as a result of share exchange, as a result of share exchange, as a result of share exchange, there will be new shares. There will be new shares calculated as follows. As a result of share exchange, there will be new shares calculated as follows. There will be new shares calculated. Let's take note of that. Number 1, there will be share capital. This share capital, it's always the nominal value. Okay, I'll explain it later on. And number 2, there will be share premium. Now, this share capital, how do we calculate it? It is number of shares, number of new shares times the nominal price. Nominal price, we will cover this as a topic in company accounts. In company accounts, we will cover a topic called issue of shares. And also next week during the online class, when we are covering earnings per share, we will also look at issue of shares. So we'll cover it in 2 topics. So number of new shares times nominal price per share. Okay. Share premium is number of new shares times market price minus nominal price divided by market price. Even this first one, it was supposed to be divided by market price. Nominal price divided by market price. So in order to get the share capital and what goes to share premium, so let me start with share capital so that I explain what I'm talking of. Share capital. Instead of going through share capital, we already know the value of cost of investment using share exchange. We know the value is 32 million. So we can take 32 million times the nominal value of the share. H Limited shares have a nominal value of 1. So times 1 divided by the market price is 2. Divide by 2. That is what goes to the share capital. The balance goes to the share premium. So what goes to the share premium? Share premium, we have the 32 million, this 32 million here. 32 million times 2 minus 1 divided by 2. So in this case, we have 32 million. Clearly, let's see what I'm doing. Times 1 divided by 2. It gives you 16 million. And the share premium is also 32 million times into bracket 2 minus 1. 2 is the market price. Divide by 2. So it gives you also 16 million. So out of this 32 million, we have found out that 16 million goes to share capital and another 16 million goes to share premium. So to be consolidated, to be added to parent share capital. And the next one, to be added to parent share premium. So if somebody asks you for the journal entry, I'm just trying to kill many birds with one stone. Journal entry. For every transaction, there is a debit entry, and the debit entry is the cost of control. And there is a credit entry. There are 2 credit entries. There is what goes to the share capital, and there is what goes to credit share premium. If you've been asked for double entry, that is what you do. There is what goes to the share capital is this total. Cost of control is that. And what we credit is this 16 and that 16. You know your capital has increased. Increase in capital is credited. So if you have been asked for the double entry, that is what you need to do. For the double entry or journal entry, whatever terminology the examiner uses. So debit cost of control, 32 million, and credit 16 and credit 16. So that is journal entry. So as a result of share exchange, there will be new shares. So I'm done with share exchange. Let me check in the chat the questions we have. Now, Fred Muneza is asking, why 2 minus 1? We said it is what goes to the share premium is the surplus, the value above nominal price. What goes to share capital is nominal price. What goes to share premium is the value above nominal price. So the value above nominal price, you take nominal price is 1. The market price is 2. So 2 minus 1 gives you the value above nominal price. The value above nominal price goes to share premium account. It goes to share premium account. You may increase size of the presentation. Maybe the person asking that in this case, this is the maximum presentation we can have. If I increase it further, it will not be proportional to the screen. Just try to enlarge your screen On your case, you can zoom your screen. You can zoom out to expand your screen. You may okay, so I've read that. Jocelyn, it's not my voice. I'm having a gadget that I'm using to test if everything is clear. I have something that I use to test if the voice is clear. So maybe it's your or item with a problem. Okay, so let's continue. I've already read the questions in the chat. So let's continue. So that was deferred cash. Now, sorry, that was share exchange. Now, also for deferred cash, how do we account for deferred cash? Accounting for deferred cash. How do we account for deferred cash? So first of all, the deferred cash is, we have found that the deferred cash is 18 million. So we have found that the deferred cash is 18 million. So how do we account for deferred cash? Remember, the payment was to be after 3 years. The cost of capital is 10%, and $1 receivable in 3 years can be 0.75. So this was to be after 3 years. So because it's after 3 years, the non-current liability, first of all, is 18 million. We have said 18 million. 18 million goes to goodwill. Used in goodwill, used in calculating goodwill, just like the share exchange. Now we said because we promised to pay, we need to calculate find accrued finance cost. What is accrued finance cost? The interest that has not yet been paid. Why interest? Because we are paying after 3 years, and if we are paying after 3 years, we have an obligation. It's a liability until we pay it. Because it's a liability until we pay it, it means there is an interest. So interest rate was 10%. The cost of capital was 10% times the present value of the deferred cash times the 18 million. So that will give us this 10% times 18 million. So it will give us 1.8 million. So the total, so this 1.8 million goes to income statement as an expense, to income statement as an expense. And also, because it's an accrued finance cost, you know that accrued expenses are liabilities. So it increases the total non-current liability. The total non-current liability will be equals to deferred cash plus deferred cash, let me just explain, is equals to deferred cash. Deferred cash is 18 million plus the interest. Interest is 1.8 million. So we have 18 plus 1.8. It gives you, so the total, this is what goes to the balance sheet as a non-current liability, to statement of financial position as non-current liability. So that's how we should be accounting for deferred cash. So we have so far looked for how do we account for share exchange and how do we account for deferred cash. Now, having an understanding of this accounting alone is not sufficient. We also need to see how do we now, once you have calculated them, how do you transfer them to the balance sheet? How do you transfer them to consolidated statement of financial position? So this transfer to consolidated statement of financial position will lead us to another example. So we can have the example 5 was showing us how to calculate the cost of investment through share exchange and through deferred cash. We have known how to calculate it, but that alone is not enough. This is just one working out of the many workings that you'll be doing in exams. So once you have done your working, the point is, how do you transfer it to consolidated statement of financial position and income statement? So remember, I've said this is used when calculating goodwill. I've said this is to be added to share capital of the parent. This is to be added to share premium of the parent. We have said this is used to calculate goodwill. We have said the accrued finance cost goes to income statement as an expense. And we have said the total non-current liability, which goes to the statement of financial position as a non-current liability. So let's have a look at another example. I have a look at another example. But because we'll be posting this somewhere, it's good to have some short presentation. So let's look at another example. Example 6. Let's be attentive in it. This will involve even consolidation. Statement of financial position of P and S at 30th June 20x8 are given below. So you have been given the parent statement of financial position, and you have been given the subsidiary statement of financial position. Remember, what is our objective? To know how to account for cost of investment. That is our objective. So additional information. P acquired 60% of S on 1st July 20x7. So P acquired 60% of S on 1st July 20x7 when the retained earnings of S were 5,800. P paid 5,000 in cash and also issued two $1 shares for every 5 acquired in S and agreed to pay a further 2,000 in 3 years' time. The market value of P's shares at 1st July 20x7 was $1.8, and P has recorded the cash paid in respect of the investment in S. Current interest rate is 6%. P Group uses fair value method to value non-controlling interest. This is good. In the previous sessions, we have just been looking at the net assets method, but now we are being given the fair value of NCI for the first time. We said that when you've been given the fair value of NCI, you use the fair value method to calculate goodwill and NCI. We will see how to do that. At the date of acquisition, the fair value of NCI was $57.50. Now, this question is showing us how to consolidate when there is a working on cost of investment required. Prepare consolidated statement of financial position of P Group at 30th June 20x8. In the previous session, we have learned that whenever you are having such a question, you start by preparing. So we are in example 6. The solution to it. We said in such cases, you start by preparing the consolidated statement of financial position. Once you are done with that, that is when you move and try to find. Once you are done with this is when you go and do the workings. So what is the name of the company? The name of the group is P Group. P Group Consolidated. Please, let's be very attentive here. Consolidated statement of financial position as at 30th June 20x8. I'm seeing some questions in the chat. Let me look at them. What is equivalent to cost of control? The equivalent to cost of control is the cost of investment, which is also known as purchase consideration, which is treated as a non-current asset under goodwill. Non-current assets under goodwill. I hope I've answered Xavier. Vincent, mean 2 minus 1 is profit for shares. No, it's not profit for shares. 2 is the market price per share in that previous example, and 1 is the nominal price. So it's it's the difference between the market price and the nominal price, which is normally taken to the share premium account. So it is just that the value of the shares increased. If the value of the shares increase, that increase in value is taken to the share premium account. Where 18 million come from? 18 million, I believe, let me go back to the example. 18 million was the deferred cash. We calculated it. 18 million was deferred cash, right? The 18 million was deferred cash. What do we mean by deferred cash? I believe you joined the class list. Deferred cash is a way of purchasing a company where you pay in future. So to defer cash means to postpone paying. Instead of paying now, you pay maybe after 1 year or after 2 years. Now, Richard, which is the number of this question? It's example 6. What I'm explaining through the charts is example 5, but this is example 6. Example 6 is in the detailed notes and also in the slides that have been previously shared. Examples 5 and 6 are in the slides, and they are also in the detailed notes, which you have access to. So let's kindly move on. So we said that whenever you are consolidating, you start by preparing the financial statements, so that in case you run out of time, you have earned some marks in exams. So that's why it's important to start by preparing the financial statement, just in case you run out of time. So we will start with non-current assets. Now, what are our non-current assets in this case? We have been given property, plant, and equipment. So look at what I'm doing carefully. Property, plant, and equipment, we can abbreviate it as PPE. And of the parent is 15,000, plus of the subsidiary is 9,500. Remember, the rule is consolidate as if you own everything, even though in this case, you own only, is it 60%? You own 60%. So we have 15,000 plus 9,500 because there were no adjustments related to PPE. If there are adjustments, you account for them, like fair value increment in PPE. If there are any PPE that is sold, you account for them. So there is investment next in the statement of financial position. There is investment in subsidiary, in S Limited. The rule that we covered in the previous sessions, investment in subsidiary is not consolidated. We only consolidate other investment. So we leave out these investments in S Limited. Investment in subsidiary is not consolidated. Actually, it is used to calculate goodwill, but we'll come back to that. So that therefore leads us to goodwill, which we will calculate. We will retain it here if it is positive, but if it is negative, we will take it as an income in the income statement. But because we don't have income statement here, we will adjust the retained earnings because we don't have income statement. So goodwill, if it is negative, it goes to the income statement as income. But because we don't have income here, we can only make adjustments to retained earnings. So this will give you total non-current assets. Our total non-current assets. And then we go to current assets, and our current assets were only one. So they were never broken down. So our current assets, they were not broken down. So because they were not broken down, we'll have it as 7,500 plus 5,000. 7,500 plus 5,000. So if it is not broken down, you just put it in that last column. But if they are broken down, you put them in the inner column, the details of the current assets. So it is 7,500 plus 5,000. So that gives you 12,500. This therefore leads you to total current assets. We cannot still get the total current assets because there is goodwill missing. So there is goodwill that we have not yet calculated. So there should be a working on goodwill. So we still don't know the working number. And then finally, we go to equity and liabilities. Equity and liabilities. And we start with equity. We start with equity. We start with equity. Now, in our equity, remember there is share capital. Share capital. But remember the rule, consolidate only the share capital of the parent. That is a rule. And then, but if there is share exchange, there are new shares premium. This is a continuation of a session we have had before. Share premium. And then there is retained earnings. And then to the equity, you add non-controlling interest. You add non-controlling interest to give you total equity and non-controlling interest. Total equity and non-controlling interest. And then we go to non-current liabilities. Which we have been given, but if there is which we have been given, but if there is some deferred cash, we'll account for it. If there is some deferred cash, we will account for it as a non-current liability. And then finally, we have current liabilities. Current liabilities. Current liabilities are 4,000 plus 1,800. So in that, unless there is a new liability, let's just finish with it. Plus 1,800. So it gives you 5,800. And this will give you total equity and liabilities. Now, if everything is right, we expect it to balance. So that is our consolidated financial statement, but it still requires some workings. So that is what we'll have at the end of the day. So let's look at the workings. So our workings, working one, will enable us calculate cost of investment. Cost of investment is our working one. Cost of investment. So how do we calculate cost of investment? Let us again read the question. Additional information one. P acquired 60% of S on first. Okay, I'm seeing more chat. Let me see the questions. Is it always share exchange give us share premium? No case of share discounts? No, it is not always the case. Share premium only arises when? Share premium only arises when shares are issued at a price above the nominal price. When shares are issued at a price above the nominal price. But if we issue shares at nominal price, there is no share premium. Is there cases where we have discounts? No, discounts cannot be here because we cannot issue shares at a price below the nominal price. I know what maybe you are thinking of is rights issue. Remember, the definition of a rights issue is issue of new shares to existing shareholders in proportion to their current shares at a price above nominal value but below market value. So even if it is discount you are referring to, yes, the value is below market price, but it is above nominal value. It's above nominal value, but below market price in case of a rights issue of shares. I hope I've answered that. Maybe one more question. How do you calculate current assets? Current assets, you consolidate, you follow the instructions. Current assets, you will simply follow the instruction. Cost of investment is, Fred, cost of investment, this is what you have explained there, is for example 5, I believe so. Please, teacher, I want to know where you find cash deferred of 18. I think I've already explained that. I think it is due to the fact that it is discounted. Okay, that is true. Deferred cash will reduce due to cost of investment. I've not said the deferred cash will reduce. I've not said that. Deferred cash increases actually the amount of cost of investment. Why will it reduce? Maybe you mean the discounting. Discounting is to convert the future value into present value. Of course, when you convert future value to present value, the value reduces because there is what we call time value of money concept. What does time value of money concept tells us? With time, money loses its value. So 1,000 to receive, to pay in 1 year's time is not the same as 1,000 today. I think I've answered all questions. Let's move on. P acquired 60% of S on 1st July 2007 when the retained earnings of S were 5,800. P paid 5,000 in cash. So, first of all, we need to see what are the methods used. Methods used in acquisition of subsidiary. The methods that we have used in acquisition of subsidiary. Method 1, we have used immediate cash. Immediate cash. So that is method 1, immediate cash. P acquired 60% of S when the retained earnings of S were 5,800. P paid 5,000 in cash. So immediate cash is 5,000. I believe everyone is seeing that. P paid 5,000. P also issued 2 $1 share for every 5 shares acquired in S. But they have not told you how many shares were acquired. You are only told they acquired 60%. So remember, in the other question, you were told 24 million shares were acquired. In example 5, you were told 24 million shares were acquired. But in this case, you have just been told 60% of the shares of S are acquired, but you have not been told how many shares have been acquired. So that leads us to number 2. Number 2, it is through share exchange. And what is the rule? Because we have not been given the number of shares acquired, look at what I'm doing carefully. P also issued 2 $1 shares for every 5 shares acquired in S. So if you have not been given the shares acquired, you go to the share capital of S. The share capital of S is 5,000. And the value of each share is $1. So you take a value of 5,000, you divide by $1. That gives you 5,000 shares. So how do you get shares? It is 5,000 shares times. The ratio was P also issued 2 shares for every 5 times 2 divided by 5. I believe in example 5, we had explained that. 2 divided by, agree to pay, the market value of P shares is 1.8 times 1.8, which is the market value. But we did not acquire 5,000 shares. We acquired 60% of 5,000. So you multiply your answer by 60% because we did not acquire 100% of these shares. So you multiply your answer by that because we did not acquire 100% of the shares. So that gives you a quick maths there, 5,000 times 2 divided by 5 times 1.8 is the market price times 60% is the number of shares acquired. So share exchange gives you a value of 2,160. Let us continue reading. P also issued 2 $1 share for every 5 in S. So we have accounted for that, and they paid a total of 2,160 and agreed to pay a further 2,000 in 3 years' time. So that is the third way they acquired. Deferred cash. So they acquired also through deferred cash or deferred consideration. So in deferred cash, if we recall what we said, deferred cash and required a further 2,000. So you will take 2,000 times, we said, 1 divided by 1 plus R. R is 6% in this case. The current interest rate is 6%. Times 6% is the same as 0.06. Raised to power, they were to pay after how many years? 3 years. In 3 years' time. So that gives you the discounted value, the present value. So that gives you 2,000 times 1 divided by 1.06 raised to power 3. It gives you 1,679. So what is the total cost of investment? Total cost of investment. So our total cost of investment, I just take summation of that. So our total cost of investment, which we will use to calculate goodwill, is that. Now, once you calculate cost of investment, that is one thing. But we said working two, I'll have it as working two. As a result of share exchange, new shares. So that leads us to number working two, new shares. As a result of share exchange. New shares as a result of share exchange. Do you agree there is share exchange? If there is share exchange, there is new shares. I'm seeing charts. I think, okay. Yes. Mugisha Gad, non-controlling interest from where? I think that's a question we have answered in the previous class. Why non-current liabilities are not recorded in statement of financial position? We record, we have not finished preparing the balance sheet. Nominal price means the original value of the shares, what is known as the book value of the shares. The nominal price is the price that is used to value the share capital. Nominal price is the book value of the shares, the one that is normally disclosed in the balance sheet, the book value of the shares. Now, when you're starting a company, you have what is called nominal value. So nominal value normally increases. The value increases as your company grows, the market value of your shares increases. So there will be a market price and there will be the original nominal value. So new shares, if you had learned what we had said before, we said new shares, there is what will go to the share capital. And we said there is also an amount that goes to the share premium, if you recall. We said nominal value goes to the share capital. Nominal value goes to the share capital. So the value was 2,160. So the share exchange gave us a value of 2,160. So we said you multiply by the nominal price. The nominal price is there in the balance sheet. The $1 is the nominal price. So you multiply by the nominal price, the $1, divide by, let me just write it as, okay, 1 divide by the market price. I believe you all see the market price was 1.8. So market price was 1.8. The nominal price over the market price. So that gives us share capital of, you take that times 1 divided by 1.8. So it gives you share capital of 1,200. The balance goes to the share premium. So the balance is 2,160 times the balance is 1.8, which is the market price, minus the nominal of 1, divide by market price of 1.8. Remember, share premium is the surplus. The surplus is what above the nominal price is what goes to the share premium. So you take the same amount times 1.8 minus 1 divided by 1.8. So that gives you 960. 960. So those are the new shares. So that is our working on new shares. So that is, we have exhausted the share exchange. But there was also deferred cash. We said under deferred cash, it leads to working 3. How do we account for deferred cash? Just a second, please. Okay, I just wanted to increase the size. How do we account for deferred cash? We said as a result of deferred cash, it gives rise to non-current liability. So we need to know the accrued finance costs and non-current liability, because it was for 3 years. So accrued finance costs, I believe accrued is written that way. Okay, accrued finance costs. So we'll start with working 3. We will start with accrued finance costs. Accrued finance cost, we said, if you recall, the discount rate is 6%. We said you take the present value, that is a deferred cash. So you will take 1679 times the discount rate of 6% to give you the accrued finance cost. So it is equals to this times 6%. So the accrued finance cost is 101. So number 2, non-current liability. The non-current liability, you take 1679, and we said you take deferred plus accrued. Deferred plus accrued. Accrued is 101. Deferred plus accrued. We had looked at it in the other example where we took 18 million plus 1.8 million. So here it is this plus that. So it gives you 1780. So with that, we are done with all workings. And we can now go and finish. Sorry, we are not done. There is working 4. The obvious workings that are normally not given. Working 4, there is goodwill. Can you just type for me in the chat section, which last 3 workings do we normally do? Even if you have not been told in exams, can you just type for me in the chat? Which last 3 workings, goodwill, what and what? If you had followed the previous session, which 3 workings are we remaining with? Chat section, please. Thank you. Goodwill, NCI, and retained earnings. Thank you. That shows we understood what we covered in the previous session. So we must calculate goodwill, and we will use which method of goodwill? You will use fair value method. Fair value method. Why will we use fair value method? There are 2 ways of calculating goodwill. There is the net assets method, the approach that uses partial, and then there is fair value method. Fair value method, we said you only use it if you have been given fair value of NCI. So you are given the fair value of non-controlling interest. I remember another person asked, where are we getting non-controlling interest? The answer is we acquired 60%. So if we acquired 60%, we did not acquire 40%. So goodwill. So let's go to goodwill. So what is our goodwill? Again, we are working in dollars. So in order to get my goodwill, just hold on. So in order to get my goodwill, we said you take purchase consideration, which is the same as cost of investment. I'm just using different terms. Investment, which we have calculated in working one. We have calculated it in working one. So we can transfer the total cost of investment was that 88. So I've just transferred working one. And then when you go to additional information 2, P group uses fair value method to value non-controlling interest. At the date of acquisition, the fair value of NCI is 5750. So we normally add in the other method, we add fair value of non-controlling interest at acquisition, given in the question. So fair value of non-controlling interest at acquisition is 5750. 5750. So what is the total? So what is the total value? The total value is 14. And then we account for net assets. Net assets of subsidiary. Or you can also call it equity of the subsidiary. You account for the equity of the subsidiary. And under equity of the subsidiary, there was share capital. There was share premium. There was retained earnings. But if you are in the last session, we said, which retained earnings do we pick? Pre-acquisition retained earnings. We pick pre-acquisition retained. So let's look for share capital of the parent. Of the subsidiary. Share capital of the subsidiary, 5,000. Share premium is 0. And retained earnings pre. Were we given pre-retained earnings? Let's see. Pre-retained earnings. Yeah, it is there. P acquired 60% of S on 1st July 2007 when the retained earnings of S were 5,800. So retained earnings pre was 5,800. So what is the total net assets? Total net assets. Now, method 2, fair value method uses. Fair value method uses total. So what is your total? Your total is that. So fair value method, remember, uses total. So fair value method uses total. So that is your total. Fair value method uses total. So what is your goodwill? Goodwill is equals to the purchase consideration is equals to the purchase consideration plus fair value of NCI minus the total net assets. Please note, if it was method 1 of calculating goodwill, you could have taken 60% of that value. 60% of that value. But now we take 100% because we are using fair value method. So our goodwill, it's positive. It's positive, so we take it to the balance sheet. Our goodwill is 3789. So I'll note that I've posted it in the balance sheet, and it is as a result of working number 4. So I can write there, if you want to know how you got it, you go to working number 4. So with that, we can get the total assets. Total non-current assets is 28,000. So we have everything. Current assets is 12,000. So the total assets is 28 plus 12,000. So that gives you 40,789. So if we are right, our statement of financial position should balance at this amount. Should balance at that amount. So it should balance this amount. I mean this amount down here. it should be equal to that. If it is not, we made a mistake somewhere. So let's go to share capital now. Remember, in consolidating, you take the share capital of the parent. So the share capital of the parent in this case is 6,000, but there were new shares. So share capital is 6,000. We only consolidate shares of the parent. Plus, new shares were 1,200. 1,200, which is working 2. Working 2. So that will give us share capital is 6,000 plus the 1,200 which we had calculated there. Share premium, also the same. Share premium of the parent is 4,000. 4,000 plus the new share premium was 960. 960, which is working 2 again. So it is 4,000 plus 960. So it gives you 4,960. So what is remaining is retained earnings and non-controlling interest and non-current liabilities. So we go to working number 5. So working number 5 from previous session, it's consolidated retained earnings. From the previous class, we said that when calculating the consolidated retained earnings, you show the amount of the parent, a column for the parent. We have a column for the subsidiary. I believe that is what we learned. So we are working our currency of operation. So we start with retained earnings. Retained earnings in statement of financial position. Retained earnings in the statement of financial position, which is 12,500 and 7,200. 12,500. 12,000. We have said 12,000 what? 12,500 and 7,200. 7,200. And then we make any adjustments that affect subsidiary. We didn't have in this case. So because we did not have any adjustments that affect subsidiary, we come and less pre-acquisition retained earnings, which we have already used it before. So pre-acquisition retained earnings, we were given in the question as 5,800. So you less pre-acquisition retained earnings, which is 5,800. What you get is post-acquisition retained earnings. Post-acquisition retained earnings. So post-acquisition retained earnings is the total minus the pre. Remember, this is the post. Now, we don't take the entire post. We only pick percentage of post acquisition. Percentage of post acquisition retained earnings, which is 60%. We acquired 60% times 1,400. So that gives you, in other words, out of this profit of the subsidiary, the parent will receive 60% of it. That is what we are trying to explain. So that out of that profit, the parent receives only 60%. So the profits of the parent will increase by 60% of that profit. Now, there was an item which is known as accrued finance cost. We said it is an expense. Working number 3. Accrued finance cost as a result of deferred consideration. We less it. Accrued finance cost, where is it? It was 101. You less it because it's an expense, and an expense affects the retained earnings. I hope we are together there. So this gives you consolidated retained earnings, which is our working 5. So what is our consolidated retained earnings? Retained earnings of the parent plus percentage of post minus accrued finance cost, which is an expense. So that gives us, it gives us a total of 13. So the consolidated retained earnings is 13,239. I can bring it in the balance sheet to save time. So working number 5. So it is working number 5. Working 5. Now, lastly, we have working 6, which is NCI. Remember, NCI is calculated when we acquire less than 100% of the subsidiary. So working 6, which is our last working for today, enables us to calculate non-controlling interest. Non-controlling interest. And we will use the fair value method. We will use the fair value method. Why will we use the fair value method? Because we said fair value method is used when the examiner gives you the fair value. How do we calculate the fair value method? The fair value method is equals to fair value of NCI at acquisition. You add post acquisition retained earnings, but the non-controlling of the NCI. NCI, non-controlling interest, which is equals to 60%. Sorry, which is equals to 40%. So the fair value of NCI at acquisition was given in the question. It was given in the question. It was, I read it. Yes, here, 5750, 5750, 5750, and post-acquisition profit you get from retained earnings. So post-acquisition profit was 1,400. So from working 5. This you get from working 5. So this is post-acquisition profit is that, but the non-controlling interest is 40%. So I was supposed to be showing the amount. 1,400 times 40%. 40% is the NCI percentage. So that is 1,400 times 40%. So that gives you 560. So the total NCI, non-controlling interest, is equals to, you add the 2. So the total non-controlling interest is 6,300 and 6,310. 6,310. So it brings us to the end of this non-controlling interest, which is working 6. Working 6 is 6,310. So what is remaining? What is remaining is non-current liabilities. Let's be attentive. Non-current liabilities. In non-current liabilities, you can see here, parent had 1,000, subsidiary had 500. So 1,000 of the parent plus subsidiary is 500 plus the new liability as a result of deferred cash. Plus, what is the new liability as a result of deferred cash? Where did we go? Yeah, non-current liability is 1780 plus 1780. Working, which is working 3. Working 3. 1780 is working 3. So let's get the total. 1,000 plus 500 plus non-current liability of deferred cash is 1780. So let's see if our balance sheet balances. The total equity and NCI, the total equity and NCI is that 31, and the total equity and liabilities is 31 plus 3280 plus 5,800. Does it balance? Yes, it has balanced. It has balanced. So that is how we account for cost of investment when we are consolidating the statement of financial position. So you have 2 examples that you can use to practice. And if you practice with those 2 examples, you'll be in a position to comfortably answer any question on cost of investment. In summary, what is cost of investment? It is purchase consideration. The amount you paid to acquire the subsidiary, the amount the parent paid to acquire the subsidiary or any other business acquired. Now, how do we calculate the cost of investment, which is also known as purchase consideration? There are 3 methods. Number 1, cash, and cash is divided into 2, immediate cash and deferred cash. Number 2, share exchange. And number 3, loans, acquired loans. In number 1, deferred cash. When there is deferred cash, what does deferred cash mean? Deferred cash means you will pay in future. Because you will pay in future, there is a liability and there is an interest, accrued interest to be paid. So remember, deferred cash results into liability, and it also gives rise to an expense called accrued finance costs. As a result of share exchange, there will be new shares, and these new shares are added to the parent's share when consolidating. Now, remember, what goes to the new shares for share capital? It is the share acquired times the nominal price over the market price. What goes to share premium is the shares acquired times market price minus nominal divided by market price. And that brings us to the end of cost of investment and also to the end of the class. Thank you very much, and thank you for your